the recording here.
In worst case, you can just erase it after.
Yeah, if I don't like it, I will. All right, so this will be the second class that I did on options. I'm not going to cover what a call is or what a put is or the tiers and all that stuff. I'll just let you know that most of the stuff we're going to talk about tonight is going to require a tier 3 level option trading, which means you have the ability to sell an option. I'm going to use a lot of the option trading that I do. I use XSP, which I told you guys before. The SPX, I did SPX for years. It's much larger. Then SPY is 1/10 of that. A little easier to trade. However, SPY can actually assign or exercise on you, and you can get yourself in a little bit of trouble when you have short legs on your tier 3 option trading. When you have a short leg sold, they can exercise those early on there because you've actually been paid a premium by someone else, whether it's a market maker or an actual trader, to exercise or assign a leg of that trade. And when I was trading SPY, I got myself in a little bit of a pinch a couple times because I always forget about they're paying the dividend. And when they pay a dividend, you're short an option, you're always going to get it assigned on ex dividend day. And I caught myself a few times over the years getting stuck with that because it does it 4 times a year. And when you're trading these things, you go out a week or you go out 2 weeks, 3 weeks, 4 weeks, and you don't think about that. You can actually theoretically be out 4 weeks on a trade and forget that the dividend pays somewhere in that 4 weeks and totally forget it, and then you get exercised on them or assigned. So they came out with XSP, which gets rid of all that. There's no assignments, no exercising. So I'm going to use, I'll probably use XXP. The options are not real great on it all the time, but I'm going to use it. I'm going to go in here and I'm going to create on the Analyze tab hang on, taking a second, there it is. All right, I already set up a butterfly on this thing. So what I'm going to do here is I'll show you, if you look at, can you guys see my screen share? You got all that up going and everything?
Yep.
Yep. Yeah.
Okay, so on the bottom here, the green portion here, it shows a butterfly. And what this is a call butterfly, okay? You can do it on the call side. You can do it on the put side. They basically do the same thing. It's easier for me to do it on the call side because it's easier for me to add numbers that are positive rather than negative numbers. So in this particular one that I set up earlier for tonight, if you'll look at it here, what you do is your butterfly is going to have a body and then it's going to have 2 wings. Okay, if it's an iron butterfly, it's going to have the same thing. It's going to have a body and it's going to have 2 wings. In this particular case, I used an at the money call, which is this 440 right here in the middle. And with a butterfly, what you do is you sell 2 contracts. If you look over here, it says -2. You sell 2 contracts. It's a minus because you're selling them. So you sell 2 contracts of the 440 call, which is right at the money. And it'd be an ATM and at the money. And then you're going to buy 1 435 call and buy 1 445 call. Okay, so what you've created here, if the stock is trading at 440, the first call that you buy of 435 is in the money already. Okay, because we're trading at 440, you've got a bought leg of that butterfly that's trading at 435, so that particular one is in the money already by $5. Okay, and then the 440s are at the money, so they're essentially worthless at this point. And then the 445 is out of the money, so you have an in the money 435, and at the money 442 of them sold, and an out of the money 445, which is going to be another one that you buy. So you've created the body at 440, and you've created the wings at 435 and 445. Okay. This is what's called a debit. You have 2 types of trade you can make with options. You either do a debit spread where you pay to have that trade put on, or you do a credit spread where you collect the money to have that trade put on. Okay, in this particular case, it's a debit spread, and the risk reward looks really attractive on it. However, the probability of success is not that great, so you have to weigh that out. So basically, what's happening here is that 435 leg, the call that you bought, is in the money by $5 because we're trading at around 440. It's also most of your options trades are going to be your value of either losing or winning on them is going to be the difference between the strike prices. And in this case, when you're buying a 435 and selling a 440, that's where you cap off your profit. So if you had a 435 and all you did was buy a 435 call by itself, then you have an unlimited upside, and you theoretically be in the money $5 at this point if it was just a call that you bought. But because you then sold one at 440, you've now capped off your purchased call at $4 or $440, which is a $5 difference between the 435 and the 440. So that $5 difference is where you cap it off. And on trading vertical spreads, you would buy the 435 and you would sell the 440, and that's all you would do. And that would be called a vertical spread. And people would say, well, why would you want to cap that off? Well, it does a couple things. It's an insurance policy, and it costs less money to put that trade on, and it allows you to trade right at the money versus having to go way out to like a 445, 450 strike to actually get into a premium or a cost of the option that you're willing to spend. So it allows you to play a little closer to the money. So in this particular one, the 435 is $5 in the money, and that's where it's capped on the 440s that you sold, and then the 445 is going to be out of the money. So the 73-cent debit is $73. So the max loss on this trade or win, if you were selling it, it would be a credit. If you're buying it, it's a debit. In this case, it's a debit. So the max that this trade can actually earn you is the $5, which is the 435 that you bought, and the 440 that capped it. That's $5. So let's say on September 1st. Let's say on September 1st, the XSP is trading right at $440.58, right where it is right now. You would realize the maximum win on this trade of $5 because you own the 435 call, which you bought, and we're trading at 440 on September 1st. So that 435 call has a $5 value, and this trade would make you $500, and the cost of it is 73 cents. So you have $73 invested in it. So you're saying, well, that's a great risk reward. I spend $73 on one contract, and at 440, I make $500. That's a great risk reward. I could potentially lose 73 to make $500. But if you look at it, the probability of success is kind of low, because what the chances of 11, 12 days from now, we're still trading at $440. Kind of low, don't you agree?
Yeah.
So while you look at it, you say, well, it's not costing me a lot, and it's got a great reward. Yeah, I also have to always look at the probability. The probability of it being at 440 right in 11 days is a little bit low, real low. So you can win on this trade on the top side or the bottom side. So the loss it lets you, it has to stay below 435 or above 435 or below 445 for this trade to win for you. So you have a $10 range in there, which is a pretty good range to be able to win with it. So that's how a butterfly works. You got any questions on that one? You probably both already understood this.
Yeah, but so like the focal point for an option spread like this would be like a really non-volatile stock, like say like AT&T or Verizon or something. You could just do this all day.
Yeah, you want to find one that doesn't move much. There's a couple things you can do. You can look for one that doesn't move a whole lot, but there's a trade-off always. You're not going to be able to buy it this cheap. You're not going to be able to buy it for $73 with a $500 potential win on it. They're just not going to let it be that way if the volatility is that low. The other thing you can do, and what I like to do is try to look at a stock like AT&T or Apple or anything you look at and you say, okay, this thing had a gap here or it had this happen, and try to find a point that you think it might pin. And then come up with your reasons why you think it might pin there and say, okay, because of this and this event and this, that, and that, I think this stock's going to actually pin at 440 on this particular date. Then you can use that date, and if you've done your homework, you can use that date, you can use that pin price and tell yourself, I feel pretty good about this. And once you've put all that together as a package, you can then put on a butterfly trade like this and take advantage of the $73 cost versus the $500 payout on it. So what you'll want to do is come up with reasons why you think it should happen. And if you got good concrete reasons, you can say, I think this, and I'm just using the XSP because that's what we're looking at. You can use AT&T, but you can look at AT&T and say, okay, it's trading at this amount. It stays in this range. I think in the next 7 days it's going to stay here, but it's going to go back to this price point. Then build yourself a butterfly on it in the call side and say, okay, I can buy this thing for, and you can set the wings at whatever you want. They don't have to be $5 like I got them here. I can set these wings out, $1. And if I set them at $1 out, it's probably only going to cost about 20 cents. Then the spread becomes $20 risk versus 100 to profit. And you can do the same thing with AT&T and Apple, whatever you want. You don't have to set them at 5. You can set them at $1, $2, $3, whatever you want. But you can look at one like AT&T. I don't have it pulled up, so I don't even know what it trades at. But you can say, okay, in this last 10-day period, here's a channel that it traded in. Here's a range that it traded in, and it always goes back to dead center. And I'm going to, and it's done that 8 times, and it's always gone back to dead center. That's where you'd want to use this trade on any stock that preferably with weeklies, because it makes it a little easier. And it has some liquid options to where they're liquid and you can get in and out pretty easily. But that's where you would say, okay, I feel like in 11 days or 7 days, this AT&T is going to trade right around here again. So I'm going to make this my body of my butterfly, and then I'm going to go out $3 or $4, whatever the channel that it's trading in. That'll delegate where you want to be. $4 out, $5 out, $2 out. And say, okay, here's my top wing, here's my bottom wing. I'm going to put this trade on. And you pop it up, and it shows up like this, 73 cents. So they can be relatively low risk trades with a good reward, but you really want to do a little bit of homework before you put them on, so that you have a thesis behind the success rather than just saying, well, it's cheap to put it on. If I get lucky, I'll get a good win. You follow me?
Yeah.
Because cheap doesn't work in options, because this stuff's all mathematically calculated and they're cheap for a reason. All right, so any questions on a butterfly? I should cover that. And we'll go into. I'm going to go. I don't like the way they set up an iron condor. What an iron
I got a
condor?
quick question for you.
Yeah.
Is there a time and place for every one of these different spreads, or are there only like say 3 or 4 that are viable?
You're saying of all the different types of options
Yeah,
trades?
Yeah, there's like 20 on here.
Yeah, there's. Let me look at. There's. I don't have it open, but there's. Go back into the analyze tab. It'll show me. You've got vertical spreads. There's back ratios, calendars. I can show you what all those are. And answer your question, there's a lot of different companies that you can do many of these types of trades on, especially ones like Apple, which their options are really, really liquid. So the trick to this is let me show you the ins and outs and teach you each one of these different types of strategies. And then, because you guys are so experienced in the market and so familiar with so many different companies, you could say, that iron condor that Moto talked about the other night, based on how this thing sets up and works, I think XYZ company would work really, really well with that. So you guys can start filling in the blanks on what companies you want to use for the particular type of options trade that it is. A real basic one here is a straddle. I'll show you one real quick. You guys may or may not even know what this is. A straddle, let's go with XSP. We're at the money. I'm going to use SPY because there's a little better options. A little more liquidity to that. So there's two types of trade you'll hear people talk about, a straddle or a strangle. Okay? There's people that do nothing. They have lots of guts. I'll be politically correct on my language here on the because I'm recording. They have lots big guts, okay, and they short these things. There's people that do nothing but make a living by shorting straddles and strangles on SPX. And how this works, if you look at what I've got lined up here in blue on both sides, on the put side and on the call side, okay, this is for SPY and this is for 440. 440 strike, and this is for expiration tomorrow. Let's go from tomorrow out to 4 days, next Wednesday or whatever. Let's see, next Wednesday. Let me click the 440 on here and the 440 on here. What a straddle is when you buy the 440 put and you buy the 440 call. So you have a debit spread and you have the combination of the cost of both of those, okay? When would you? So I'm going to indirectly answer your question here. If you look on the put side over here, we're at 241, 246, 241 bid, 241 or 46 ask. So you can fill that side for about 244. Okay. Go over to the call side, you've got 248, 252. You can fill that for 250. So you got 250, 244, which is what, 494. That's your cost to put on a straddle for an expiration on SPY for next Wednesday. So you've got $4.90 something cents invested into that option strategy at a 440 strike, which is currently today at the money. So what needs to happen? It needs to trade outside of the 440 plus your 449 you paid for that straddle, the put side and the call side added together is 440, 490, I think it was. We'll use 490 because I can remember that. It has to trade outside of that 490 for you to actually really make profit on this thing. So because you're buying a put side, you're buying a call side, it can go either direction. You don't care if it goes up $4.90 or if it goes down $4.90. Either way, that's how you become the winner on this trade. So it's a universal trade. It's versatile in that it allows you to play both sides of the field. You can play a put and you can play a call. You just need the stock to move. So going back to Mitch's question, are there certain things that lend themselves to a certain type of option strategy? Yes. This is the type of trade that, as you can see, needs to move. It needs some movement. So you could play an FDA approval. You can play an earnings. There's several things that can make a stock, an underlying stock, move and move it good. Okay, so Wish would have been a perfect example. It got killed in earnings. So to attach a trade to a strategy, yes, in a straddle, you could say, okay, so any stock that I think is really going to move is one that I'm going to look at putting a straddle on. So do you think that SPY is going to move $4.90 to make yourself some profit off of it by next Wednesday? There's probably not a real big catalyst to make that happen. So this wouldn't probably be the perfect one for it, but I'm using it as an example to see how you price it out. Now, if I go to, let's say we're in a little bit, we're jumping around a lot right now. We're bouncing, even though the volatility isn't real high, we're still bouncing. They're running the mark, they're running the SPY, $3-4 in a day. They'll run it way up one direction and bring it down. Like today it went 441 high, 436 low. So that's a $5 move in one move, and they've been doing that for a couple days now. So you're really getting a decent move. However, it's coming back to square one is what's happening. And you don't want that because these aren't going to work then because they're going to barely get to the edge of where you make money and then they're going to come back again. So if you need a $4.90 move, this is probably not the one to do it. However, there's a little bit of trick that goes with these kind of things. You need to go, and here's where it gets a little tricky. Say you have XYZ company and they're coming out with an FDA phase 3 approval, and it's 3 weeks from now. You want to try to put on a straddle trade like this, or the strangle, which is the next one I'm going to show you, about 2 to 3 weeks prior to the event, because it's not going to have all the premiums loaded up into the options that are going to be loaded in there when it gets really close to the event. So you want to look up a stock and you want to say, okay, this is an FDA play. I'm going to do a straddle like Moto said. I'm going to put it on 3 weeks prior to the event taking place. You do take a little bit of a risk in that it moves away from the strike that you put it on at. If you got to give it 2 or 3 weeks to happen, there is a little bit of risk. It moves away from what's now at the money strike. However, if it moves out in just a little bit, say it went in this case it's 440, say it went to 438, that's a $2 move. So you've gotten your $2 move of the 490 that you need. So you got a little bit of the move, but these are going to depreciate. The theta is going to eat them up. So that's where this particular trade lends itself to is an event that's going to happen, and it's going to make the stock move more than likely, and you're going to want to try to put it on a little early. Now, if I go to SPX, there's a lot of people I told you make a living just doing this. If you'll look at the one that expires 4 days from now, we're at 44.05, so I'm going to go 44.05, and it's a risky game. I've done it before, and it works until it don't. It's one of those things that you've heard the saying, this works really good until it don't. Okay, so look at the 44.05 here. I've got a blue line on the right, blue line on the left. Okay, we're at roughly $23 on the right side on the puts and $26 on the left side. So 23 and 26 is $49. Okay, so one contract you're going to collect. If you sell this, and you're a seller, and you do what's called naked sell it, to where you don't put a buy order in to protect it or cap it off. You're just a naked straddle seller. And there's guys that do this for a living. They're really good at it. You need to be, because it's one of those things where 9 trades work, and the one that doesn't takes the 9 and erases them. That's what you don't want. So in this case, you got a $49 value on this straddle. There's guys that sell that because that one contract is worth $4,900. Okay, you just don't want it to move outside of that $49. You want it to stay in that $50 range until next Wednesday, because this one has an expiration of the 4th. So what they're needing is, they're saying, okay, I don't think SPX is going to move $50 or more between now and next Wednesday. That's the risk they're taking, because they're selling these things naked and they don't have anything protecting it. So if an event comes in where some news drops, or something happens with COVID or whatever, or the war or something, and all of a sudden SPY moves $300, you're going to take a beating like you've never had, because you're going to be, you collected $49, and all of a sudden it moved $200. Now you got, you collected $4,900, and now you're out $20,000. So like I said, it's one of those that works until it don't. When it don't, it usually hurts. I used to do these a lot, and then I got one that hurt, so I stopped doing it. So, okay, do you understand the straddle position? Did that answer your question at all, Mitch, on where you associate a type of trade to a type of option play?
Yeah, so these would just be any sort of maybe like earnings or something. You don't know which way it's going to go, but it's going to be volatile, so you put
exactly.
This
is allowing you to play on both sides. You just need it to move. Okay, and a lot of guys will do these on companies that are doing earnings, because if you notice, a lot of these companies, how many times have you said, man, everybody that bought puts or everybody that bought calls, they all got hammered because the stock didn't move. A lot of that goes on, and these guys know that, so they wait until a couple of days before earnings on one like Tesla or Apple or something, till these premiums at the money are really super inflated, and then they'll naked sell these things on both sides, do a naked straddle, with the hopes that the stock doesn't actually move, and it kills everybody on the options around it. Everybody that's bought the options, bought them long, long puts, long calls, they all get destroyed because the stock didn't move. But the guy that's selling those is the one that somebody's on the other end of that trade. Somebody's making that. Somebody sells that, whether it's a market maker or an actual individual. Somebody that sold that is collecting all those premiums because the stock didn't move. All right. Next one, basically got the same thing. It's a strangle. We'll go back to SPY. Straddle is when you do them right at the money and you pay a little bit more. And a strangle is when you move out of the money a little bit. Do the exact same thing. So in this particular one, we're trading at 440. We'll go to 440. What was that going to cost us? What did we decide? It was 490 or something, wasn't it? Okay, so 490 lets us play a straddle that expires next Wednesday, 4 days from now, right at the money at 440. Okay, if you do a strangle, okay, you go out a few bucks. So in this case, we'll go to 437 on the downside, and we'll go to 443 on the upside, on the call side. So now we're $3 under on the put side where it's trading at the money, and we're $3 over on the call side where it's, there you go, perfect. So this one is going to cost you about $1 plus $1.56. So this one's going to cost you about $2.56. So rather than have $49 on the line, $490 on the line with a $4.90 cost, you're going to have $2.50 on the line. So doing a strangle versus a straddle is you put $490 in a straddle and hope it moves outside of the 490. If you do a strangle, you go out a few strikes, and it costs you only $250. The concept is the same. You're wanting the same result. You're wanting the stock to move. But in this particular case, you've now spent $250 versus $490, but it has to move $3 before it actually starts working for you. So if you think about it, theoretically, it's got to move $3 before it starts working, and you paid $2.50 for that, so it actually has to move $5.50 before it really starts to work for you, versus the $4.90 you needed when you played right at the money. So when you do a strangle, it costs you less, but the trade-off, it has to move more. The volatility has to be a little higher. It needs to make a bigger move. It needs to get on past your strikes plus the 250. So It needs a little bit more movement, but it's the exact same pretense as the straddle. Does that make sense? Y'all on board with those two types?
Yep.
Yep.
So
Makes sense.
you can do the exact same thing with the exact same type event coming on a company. You can say, okay, I'm going to play this as a strangle because, well, I think they're going to get a pretty good move. I think they may get a big enough move to make it work. I don't want to put $490 per contract out, but I'm okay putting 250 out. So you put 250 bucks on it. You do one contract, or you do two contracts. You got 500 bucks versus playing at the money for 490. And you say, okay, if I do one, I got 250 bucks on the line. If it just doesn't move at the event, then I'm out 250 bucks versus 490. So it allows you basically to do the same thing and hope for a big move. But if you don't get the big move, your out-of-pocket loss is reduced. Okay. All right. Next one is an iron condor. Okay. Basically, what an iron condor is it's two credit spreads. Okay, it's where you're collecting money on one side and collecting money on the other side. And the basic rule of thumb, and there's a girl that Tom Sosna, or whatever his name is, that one of the founders of Thinkorswim, he mentions her name all the time. Her name's Karen. I don't remember what her last name is, but everybody knows this Karen. And everybody talks about how she was so successful. She did a lot of this type of trade. So basically what you have here is it's an iron condor. I'm going to click on some numbers here. And if you have Thinkorswim, the range that she played in is in the 10, 11, 12% range. So if you'll go over to this line that I've got marked here on the 429 strike, okay? I've got the 429 on the put side. It's blued out. It shows 12.31. That's the percentage that Thinkorswim shows that it has the probability of moving in the money at that strike. Now, that's good today, and that's great today, and it looks good today, and you say, oh, it's only got 12%. But these are theoretic values that change daily, and a big move in the stock, then that could become 50% tomorrow, and you're like, okay, well, wait a minute, this was 12% yesterday, and now it has a 50% chance of going in the money. There's that likelihood of that happening when you're playing iron condors. You want the trade-off is low volatility, doesn't make big moves. The trade-off is the premiums are going to be much lower, so you're not going to collect a whole lot of premium. So you may have to do 10 contracts that you only collect $100 on, but the probability of you getting your $100 is really high. Versus high volatility, where you may collect $300, but the probability of the thing going against you is it moves up and gets considerably higher. So an iron condor, what this would be is we'll take the 429 strike. It shows that it has and I'm not even going into all the thetas and the deltas and all that on these things. I'm just telling you the basic trade and how it works. You guys can use the analyze tab on Thinkorswim, or you can do the math yourself to say, okay, if I put this iron condor on, how's it going to be affected from a theta standpoint? How's it going to be affected from a delta standpoint? If this is the type trade that you like, and I knew a couple guys in one of the other rooms I was in, these are trades he loved. And he did these on SPX on the day of expiration, and he did great, but I've seen him get burnt too. He'd get $200, $300, $400 in an afternoon consistently over and over and over, but then when they went against him, he'd lose like $5,000 really quick because he did them naked. He didn't put the buy side on. And so, like I said, that's one of the things that works until it don't. But I've seen this guy do this over and over and over, do really well with it. However, you can get bit. So in this particular case, an iron condor would be where you sell the we're going to use the 428 because it's 11%. So you sell the 428 put, but we're going to use 50 cents to make it easy. Okay. It has 11% chance of probability of going in the money. And then you don't want to do it naked, so you have to cap that off somehow. So you're going to buy the 426. Didn't want that to do that. You're going to buy the 426 put for 40 cents, okay? And it has only an 8.86 chance of going in the money. So what you've done is you've created a credit spread, and you're putting on one leg or one side of the iron condor. You're selling a 428 for 50 cents, and you're buying a 426 for 40 cents. So the credit on that is going to be 10 cents. You with me? You're selling the 428 at 49, 50 cents. You're buying the 426 at 40 cents. Okay, so you have a 10-cent credit, not a whole lot. Okay, but the flip side is it's showing today it has an 8.86 chance of going in the money on you, which is low. And then the one that you sold has an 11% chance. So overall, there's added together, there's about a 9.5% chance of success on this trade. But you're only collecting 10 cents. The risk on it is that this thing trades below the 426, and the 428 that you sold is going to be the loss is going to be the difference between your sold one. Remember I told you earlier, it's the difference between the two strikes. So your sold one is 428, your bought one is 426. So the loss on this thing is $2. So on one contract you're risking $200 to make 10. So the risk reward on this one is the opposite of the other one we did with the butterflies. It's a horrible risk reward. However, the probability of success is really good. You see how I flipped that razor from what we were talking about with the butterfly? You know, the debit was cheap, the reward was great, the probability was low. Okay, this one, the credit is pretty minuscule, the risk is pretty high, but the probability of it happening is low. It's only got a 9% chance in the next 4 days of it actually happening. Okay, plus this is only one side of your iron condor. So 428 is your sold leg, 426 is your bought leg. Combined, they have a 9% chance of actually going in the money. So that's the risk percent. And you're collecting 10 cents on this trade with a max loss of $2. If the stock were to go under 426, then the 428 would be the difference between the 428 and the 426 is $2. That's the max you could lose on this side of the trade. So you collect 10 cents, you risk $2. You have a 9% chance of success that it doesn't happen to you. Okay, so we went, how far did we go out? We got to do the same. So that's one leg of an iron condor. Okay, now we got to go over to the call side and do the exact same thing. Okay, that's why it's called an iron condor, because it's building a strategy on both sides, hoping it doesn't have a huge move. So again, this type trade lends itself to certain things that you look for. We talked about the butterfly, don't want it to move. Straddles, strangles, you want a big move. You want to play on an event. You want to play on an FDA approval. In answer to Mitch's original question, again, here's one that you want to say, I want to find a stock that I can look at, statistically, it doesn't move ever into this 9% range to where it takes out this 9% probability. I don't know what company that is, but you can find companies and you can say, I like doing iron condors. I like the risk reward's a little skewed, but the probability is so high they work most of the time. So this is the type trade I want to play. You're talking to yourself, and so you're going to find stocks that are conducive to doing this type of trade. So now on the other side, we're going to go over here and we're going to look at a 446 call. It's at 11%, and it would bring you in about 29 cents. And then we're going to drop back $2 and look at a 448, which is $2 difference, just like we did on the put side. We're going to buy the 448, which is going to cost us about, we'll use 11 cents. So if we collect 28 cents and give up, we'll use the asks on both. So if we collect 28 cents and give up 12 on the call side by selling the 446 strike and buying the 448, we're going to collect 16 cents. Okay? So now we've collected 16 cents on the left side here on the call side.
Wait, sorry, which one were you selling? Which one were you buying?
Okay, on the call side, I've got the blue line here. We're going to sell the 446.
Okay.
Which is an 11% probability of staying out of it going in the money. And then we're going to buy the 447. So we're collecting 28 cents on the 446 we're selling. We're giving back 12 cents on the 448 we're buying. So we have a 16-cent credit there. So if you take the 16-cent credit and add it to the 10-cent credit that you got over on the put side, you now collected 26 cents. Is it great? No, but did it make it a little more attractive? Yes. So now you have a potential $2 risk on both sides. You can either, the stock can go shooting up and get above that 448 strike that you bought, and the 446 strike call is going to be in the money $2 and you're going to lose $2. But now you've collected at least 26 cents versus the $2 that you can potentially lose versus the $10 that you had on the call on the put side. Okay? when you look at the pricing, it lets you see how they're leaning on these things where it's skewed a little bit. You ask yourself, why can I get more on the call side than I can on the put side? They're leaning towards people buying calls on this, so they've inflated the premiums higher on the call side because, as you can see, the market doesn't seem to like to go down much. So they've leaned a little higher. So if you want to play calls and you want to play for stocks to go up, you're going to have to pay a little bit more in premium. In this particular case, it works good because it increased the 10 cents to 26 cents. So now you have what they call an iron condor. Iron stating it's on. You're playing both sides of the field. You're playing the put side. You're playing the call side, and it's iron because you've capped it off. You've capped your risk off on the call side and the put side at $2. The difference between the two strikes. So on the put side, it was 426 versus 424. I don't remember what. No, it was 428. Excuse me. It was 428 versus 426. So that's $2. We collected 10 cents. $2 risk. On the other side, we're at 446 plus. From the 448 is $2. We collected 16 cents. So now we have 26 cents or $26 per contract that you play. Okay, and this thing expires in 4 days, and all it has to do is close under the 446 strike that you have on the call side and above the 428 strike that you have on the put side. So if it closes above 428 and below 446, then your iron condor was a successful trade, and all of the 4 legs that are on this thing will expire out of the money, and there's nothing to close. So you basically, that iron condor worked, and it expired out of the money, all the legs, and you collected $26 a contract, and that gets credited into your account, and there was no loss. That's your iron condor. It makes sense?
Yeah, it's cool.
Okay, so
Yep.
that's an iron condor, and we already did the butterfly. Now we're going to go move into the trade that Razor and I took that I gave him last Friday. And this one is one of my favorite kind of trades. I do tons of these all the time. All right, now what this is called an iron butterfly. Basically, what you're doing is you're taking the other 2 trades and putting them together. Okay. So what we did here last Friday, let me look where we were at. I want to say last Friday when I told Razor about this trade, I think we were trading just under 447. Okay. Let me put XSP in my chart and I'll put it up there. X. We were trading right around 447, just under it when I told Razor about this trade. And there's the chart. So let's see, today's Thursday, Wednesday, Tuesday, Monday. Yeah, we were right up around that 447 range. So what I told Razor, I had to get a drink of water. I said, I think this thing's a little tapped out. It's due for a pullback again. And if you look at it on this chart, I said typically what it's done is there was 4 of them that did. I'm going to add a little bit more time to it. We're up to 5 months. I showed him this chart and I said, if you'll look, this thing came in here, right in here, and it tapped the 20-day. The red line is a 100-day moving average on this chart. The blue line is a 50-day, and the green dotted line is what's called the means for the Bollinger Band, and it's a 20-day moving average with 2 standard deviations, one on the top, one on the bottom here. I told him, I said, if you look at this thing, typically what it's done is it's come down here and it's hit the 20-day, and then it bounced, went a little bit below it. In this particular case over here, can you guys see where I'm circling? I can't see because it doesn't let me see while I'm streaming.
Yeah.
It tapped the 50-day, and then it went on up and went above the 20 again. Then we did the exact same thing here again. It went to the 20-day, went a little bit below it. It tapped the 50-day and went up above it. And off she went again. Same thing here. This time it gapped down below the 20, okay? I kind of thought, I wasn't totally sure, just for the record, I wasn't totally sure if it was going to gap down or if it was actually going to bounce off yesterday's candle. And for that reason, I typically don't like to trade for a break even, but I've been short on MES futures, a couple contracts, for a while now, all the way since back here. And yesterday I got to $2 within a break even, and I took it. Because I just, the market doesn't play fair anymore. Typically if you look at this, it dropped a gap down here. There was the potential this thing could have gapped down today and hit to the 50. Don't you agree? If you look,
Yeah, I
if
really
you-
Yeah.
thought
if you
I
look-
really thought it was gonna go lower today.
I did too. But I thought, it never has made sense for a long time now. It could easily bounce tomorrow, even though we have this huge red candle yesterday. And the hammer candle kind of tells you, maybe, they did buy it back up for the day. But then I went looking at the other ones just like it. And here was one, here was one, and then they ran the stupid thing. Typically they would run it after a candle like that, but they didn't from 2 days ago. They tanked it. And I thought, okay, there's a good chance this thing's probably going to go down tomorrow, but the way this crazy market trades, I'm not going to risk it. And when I got even on my futures, I took them. So I'm out of the futures for right now. Okay? But my thesis behind the trade that I put on with Razor is this thing's going to come down to the 20, hopefully again, and it may go down and tap the 50 just like it has. And this could technically, if you look at it here, could technically do it yet. This white candle today doesn't necessarily mean that we're back on track to go up. Do you guys agree?
Yeah, I think it's pretty
Yeah.
likely to roll over
Yeah.
at this point with
So-
how extended we are.
So what I told Razor is I said we want to give this thing enough time, this iron butterfly, so that it can go down to the 20, drop below the 20, potentially tap the 50, and then crawl its way back up to the 20 again. And when we put the trade on Friday, the 20-day moving average, the dotted line was right at 440. Okay, so that's where we took the trade. So now, what do we do on that trade? Is we take and you sell. On this particular one, we'll call it the butterfly, iron butterfly. You still have a body and you have two wings. I typically, if I'm using XSP, I'll use a $5 wing. Okay, you can use bigger, you can use smaller. You can trade with a $5 wing, with a $10 wing, or whatever. If you want to play bigger and you say, well, I'd rather use about a $40 wing, then get off XSP and move up to SPX. I played it tons of times and used $40, $50, and $60 wings. Okay, you got to put your risk is higher. You're going to be 10 times the risk is what you're going to have on doing these XSP trades. So on this one, the 440 I'd said on Friday, I think it's going to hit the 20-day at the 440. What we want is we want it to go down to that 440, and then we want it to drop below that 440 on the 20-day a little bit, and then crawl itself back up there. We don't want it to happen right away or real quickly, because the premiums won't get dissolved inside these each one of the legs if it happens too quick. And it kind of did happen too quick. However, the trade is green for us. So what we did is on an iron butterfly, if you remember on the butterfly, you sell two at the money and you buy one out of the money and buy one in the money. On this one, we sell a 440 call. Okay, that's where the 20-day was last Friday. So we sell a 440 call and we sell a 440 put. If you'll look on my red one here on my analyze tab, I've got a 440 call sold and I've got a 440 put sold. So basically, unlike the butterfly, this puts us on both sides of the table again. Okay, and then what you want to do is you want to buy a out of the money call. In this particular case, is $5 higher. So we sold the 440s and bought the 445. So when we bought the 445, that put us $5 away from the sold strike. So the max loss on this trade would be $5. Okay. However, when we put the trade on, that 445 and the 440 sold ones were already in the money when we sold this trade, because we were trading at about 446, 447. So everything we put on the call side was in the money. The trade-off for that is it made the premium much higher. Okay, so most people are looking at what's going on at the money. They're not speculating what they think could happen, which is what we did on Friday with this trade. And I said, because we're speculating it, and this is what I think is going to happen, it should happen, could potentially happen, we're going to put this thing on for that trade to trade here. The value in doing that is the credit was much higher. Razor got $4.51 per contract. Okay, so the max this thing can lose you is if on September 1st it's trading above the 445, because the 445 would be the cap on the one you sold, which is the 440, and that's $5. Okay, so the most the trade had at risk was $5, and that's if on September 1st it's trading above 445. However, he collected $4.51. I couldn't get it to fill on Interactive Broker quite as good as he did. I got a 449 fill. So he's got a little bit better, but not that big of a deal. So at 440 or 451, he has 49 cents at risk. Okay, are you following me with this? I want to make sure you guys follow me because I want to make sure you understand how these work because they're fun to put on, but you got to understand how they work. Are you with me still?
Yeah.
Okay.
Yeah.
Okay. So we sold the 440 call. We sold the 440 put. We bought the 445 call, and we bought the 435 put. So as you can see, we're $5 above and $5 below. So there's a $10 range that we have to play with there. The max loss doesn't come unless it's above 445 or below 435 on September 1st. Okay? And the maximum loss is $5 because the sold ones will be in the money $5. We cap those sold ones off by buying a call and a put $5 away from the body. That's our win. So we bought them $5 out. So there's where we cap this thing off with a $5 max on the trade. The difference between the strikes. The 440 to the 445 is 5. The 435 to 440 is 5. That's our max loss. But we collected $4.51. So the only risk on the trade is if it were to close above the 445 or 435, it will be a $5 value, and you collected $4.51, so you have $49 at risk, 49 cents. Okay, do you guys understand that?
Yep.
Okay. The beauty of the trade, which Razor found out by getting into it, is it's a credit. So we're collecting money on this. So the trade itself, the only out-of-pocket expense in this trade is the commission. And in this particular case, I can trade these things for like $2.80 per contract for each one of the four-legged condors that I put on. His cost was around $5. You use zero capital. It does use margin, but it uses no capital. So you put this trade on, he has a 49-cent risk or $49 risk per contract against a $4.51 profit or $451. He used zero capital. It cost him $5 to put it on for commission, and you just let it sit there. There's nothing you have to do to this trade. Okay? So where the value in this thing that comes in with XSP is there's nothing that can be exercised or assigned, unlike SPY. With the XSP, you have a couple choices here. You can let this thing go all the way to expiration. It's probably not what you'll see happen is it's going to go into your favor and it's going to go out of your favor. It's going to go back in maybe, and it's going to go out. So you're going to watch it go in and out, especially if you got a couple weeks on the thing. The chances of it actually pinning 445 on September 1st are probably not that good. 440 are probably not that good because it's still 11 days away. However, let's say it does pin that 440. If it pins that 440, the 445 strike calls that you bought are worthless. The 435 strike calls puts that you bought are worthless. The 440 strikes that is your body of this thing go to worthless or go to zero. Okay, so you collected $4.51. If it trades at 440 on September 1st and closes exactly, let's say it just closes exactly on 440. Everything on this thing, the ones you sold, the 440 call and the 440 put go to zero because they're of no value. It's trading at 440. So if it goes to zero, you will see that credit amount that you collected of $4.51 go to zero. So it's basically like shorting a stock. Okay? So if in the event you were to get lucky and trade at 440 on September 1st on our expiration, you would keep the entire credit that you collected. Okay? That's yours. It was put into your account as soon as you sold the trade. Let's say you decide, on a trade like this where I'm risking $5 credit, I'm tying zero up in capital, and I've got a risk of $49 or $49 per contract. We did a couple contracts, by the way. So on two contracts, he has $98 at risk. So what you can do is you can look at this and say, okay, if it goes down to $2.20, I'm going to close this trade. Because at $2.20, I sold it for $4.51, so I'm up $2.30. $2.30. So I'm up $230 on the trade. I only spent $5 on commission to put it on, and my risk was only $98 if the trade didn't work at all for me. So at $200, $250, you're up 200% on the trade theoretically, because if you think about it, if you invested in a stock and you spent $98 and it went to $250, you're up what to almost 200%, 150%. So any trade that you put $98 into and it goes to 250, you're probably going to take your profit because you're up 150%. That's the same theoretics that are working here, in that you had 98 risked. Fortunately, you only had $5 actually invested in the stupid trade. So if you could take it at 220, you actually made really good profit based on what you had on risk, and especially the fact that it used zero capital and you only used up $5 in commission. So, in answer to your question, and you asked me this earlier today, do I have to let this go to expiration? No. I usually don't, because it's one of those trades that when it gets right and it gets really right, it's going to go away on you. And then you have to sit at and say, I could have taken $200 on this stupid thing. Now I'm back to, making only 10 on it. So if it gets in a price range where you're happy with it, you tell yourself, you got to be disciplined on it. You can tell yourself, I used to tell myself, if I make $130 on them and I have less risk than that and only commission out and zero capital tied up, I'll take my $130. I haven't done them in a while, so I don't know if I'll stick with that. Let me see how the market moves and reacts to these things, and if I can make 200, maybe that'll be my set in stone price. I'll say, okay, when I make $200, I'll take them off. You follow me on that?
Yeah. So
Yep.
how do you exit the positions? Because
you have one of two choices. With SPY, with SPX, trading this trade, if it closes and it's in the money, if any of the legs are in the money, you have to physically close the trade out at expiration. If you don't, and your account can't handle you being assigned, one contract is 100 shares. So in our case, we got 2 contracts, which is 200 shares. If your account couldn't handle being assigned 200 shares, or if the short leg's in the money and you would be assigned 200 short shares, which you can't even do in an IRA, your broker will close it out. That all went away when they came out with this XSP. There is no assignments, which is while you look at it, it trades like SPX. There's zero volume on XSP because you can't actually trade the underlying. You have to trade options on it. So in this particular case, it does what's called cash settled. Nothing's assigned, nothing's exercised. Let's say it closes at 448. Let's say it closes at 448. No, I don't want to say 448. 443. Let's say it closes at 443. If on September 1st it closes at 443, you can just let it go into expiration, okay? Because they will cash settle this. The sold 440 calls will be worth $3, okay? The bought 445 call will be worthless. The sold 440 puts will be worthless. The bought 435 put will be worthless. So the only thing of any value in this trade, if it closes at 443 on September 1st, is the sold 440 call, and it's worth $3. That will cash settle in your account for $3. Okay? You sold it for $4.51, so that minus the $3, when it cash settles, you made $1.51 profit on this thing, or $151. That's if you let it go all the way into expiration and you don't even touch it. You just let them close it for you. That's option 1, how to close it. Option 2 is you've created a credit spread. So you would do the exact opposite of this trade and create a debit spread. It's like selling stock short. If you sell stock short, you collected money, and to close that, you have to buy it back. You have to create a debit spread with this and buy this back. So let's say you sold $451, it gets to $220, and you're like, okay, I'm up $230 on this trade. I'm good with it. I'm not going to let it crawl away from me at this point, so I'm going to close it. So you would then buy a 440 call, sell a 445 call, buy a 440 put, and sell a 435 put. So you're creating the exact opposite trade and buying it back. Okay, and if it's trading on toss, think or swim at $2.20, you can say, okay, I'm gonna let it sit here, see if I fill, because they always usually post on the analyze tab the mid fill. If at 220 it's not filling, you can say, okay, I'm buying this, so I'll go a little bit higher. I'll go to 222 or 224 and make sure I get filled. So you go to 224 and it fills, and now that's your second way to get out of this trade without waiting till expiration.
Gotcha.
Does that answer all your questions?
So like that's Yeah, so that's like what Razorback could have done today, right? Because
today if
Razorback,
he
you
wanted.
said
I
you were in
think
the
he
money
was
with
up.
your.
I think didn't watch it 100%. I think you were up like $55 at one point on this trade, weren't you? Did it ever make?
Yeah, it was something like that. I don't know.
I don't think it ever made it to 60. But keep in mind one of two things. If you close it out as a debit spread, you're going to spend the same $5 commission that you paid to put the trade on. If
Right.
if
Right.
you let it
So
go through expiration and you have nothing to close, there's no commission because you're not closing anything.
what do we want it to expire at? Best case scenario.
When do we want it to expire? Well, best case scenario of this trade is it's trading $4.40 on September 1st, because that's the body of the butterfly part, and both of those will
Okay.
go to worthless, and we got them sold. So we've sold those. We want those to go worthless, and then if those go to zero, we collected $4.51 per contract, which is $451. We then make $451. And I will tell you, even though we decided, we talked about the 49-cent risk on this trade, or $98 on two contracts. Even on expiration day, you will not realize the max loss on this thing unless you let it go into expiration and close for the day and let them cash settle it, because they will still maintain a value on this thing even the last 2 hours of trading on expiration day. Because you got to remember, we've only got a $5 wing here, and this thing could easily move a buck or $1.50 in an afternoon on a Friday. You know what I'm saying? So, they're not going to make this thing worth $5 flat 2 hours before the market closes. If it's deep in the money, it'll be a little harder to get out, even though it shows, maybe it's worth $4.94. And you say, well, this thing's not going to work for me because we're out of the, we're still deep in the money with it, and I'll just take my $4.94 rather than $5. It's probably not going to fill you, because the true value of it is $5. And in the probability of it going out of that $5, if it's really low on a Friday afternoon, you're going to take the max loss. Just let it cash settle and forget about it. All right. So you following me so far, both of y'all?
Yep.
Did that answer the questions you had earlier today?
Yeah.
Yeah.
All right. So what I did yesterday is, let me get my mouse to work here if I can find it. I put on a, let's see. What I did yesterday, I'm going to put the chart back up. Okay. Yesterday I put on a 430, 435. The body's 435. The butt call is 440, and the butt put's 430. So I put on a 430, 435, 435, 440. The reason I did that is because 435 is where the 50-day is. Okay. And I gave it a little bit of time. I went with a September 7th. Okay. So that one has a little bit more time. So what I'm thinking on that one, if you look at the chart, is the 50-day moving average. As you can see, 4 times here, 1, 2, 3, 4, 5 times. It dipped to the 50-day but respected it. Okay, so I looked at this as, yes, I probably didn't time it perfect on a 435 to be able to get the exact 435 pin on September 7th. However, I'm going to take a chance that it does what it did 5 times in a row here and dips down to that 50 and drops through. There's 3 things that can happen here that'll work in my favor. If it dips down to the 50-day and gets stuck, then all that the theta in this thing will eat up all the premiums, and I'll make a little bit of money on it. If it dips down to the 50-day and then drops through, that'd be a good thing for me, because then that 435 will start to work. If it drops through and comes back to the 50, this trade will still be working for me at 435. So there's a couple of ways that this thing could work for me. And I looked at it as it's done this 4 times in a row. And so or 5 times in a row, I'm going to take a chance it does it again. So when I put the trade on, here's the important thing. I got that filled for $4.68. So if I did here's your little quiz time. If I did a 435 body where I sold a 435 put, 435 call, and then I did a 440 on the upper side and a 430 on the lower side, what's the max risk on this trade? Total risk.
Wait, say the numbers again. 440 to 430.
It's 435. Yeah, 435.
It'd be $5.
$5, just like the other one.
Yeah.
in about 2 classes, you guys can easily answer that because you'll realize, hey, Moto always does $5 on these trades. So it become an easier question. So I got a $5 max risk. I collected $4.68. So if I collected $4.68, what's the most I can lose?
Would it be the amount that you paid the credit?
It'd be the most that the trade can lose for me, which is $5 minus the $4.68 credit that I collected, which would make it 32 cents. Okay.
Yeah.
So
Yeah.
I have 32 bucks at risk. I did 2 contracts on that one. So I've got 64 bucks at risk, and 2 contracts cost me right at $5 for both contracts, whereas Razor has to pay that for one, I think. So I got $5 risk on commission, and I've got 32 cents times 2. So my risk on this trade is 64 bucks. Okay, that's the max risk, and that's for me hoping it pins near that 50-day, the blue line on there, and get stuck. So what makes these really work well for you is, first of all, I got $64 at risk. If the thing just goes above my 440 strike or below my 430 and gets stuck, then I take the $5 realized loss versus the 468 I collected. So I lose 32 bucks a contract. But what I want to see happen is I'd like to see it come down to the 50, drop down below it, and then maybe get stuck a little bit, and investors become indecisive. Because in the past they're going to say, all right, so every time the stupid market sold off the last 5 times down to 50, it bounced. So what a better opportunity for market makers to have all that retail thinking go in that herd direction, to where, okay, so it goes to the 50-day, it's going to bounce again. So what would be the ultimate thing for the market makers to do? Let it go down to the 50, drop a little bit, and get a whole bunch of long investors investing, and then tank it. Because everybody went long.
That's what I imagine is going to happen.
They don't replicate things. In fact, I'm surprised they replicated this 5 times. So my thought process is, okay, they bring it down to the 50, they drop it below, a whole bunch of people get in this thing and invest, and the market makers hand it to them, and this thing drops down to the red line, which is the 100-day. Now you have a whole bunch of people that are confused because they're like, okay, well, this thing, it bounced 5 times. It didn't do that this time. Now it's down to the 100-day. What is it really going to do? Okay? So all the time, keep in mind, I've got very little at risk, 32 bucks, for them to think about it and for things to happen for the next 2 weeks. I'd love to see it go to the blue line and then drop below it, a couple days sideways, get people confused and think, okay, it's always bounced, so we're going to invest long. We're going to start buying the dip if you watch the news channels. And they buy and then they drop this thing down to the red line, and everybody gets really freaked out and starts saying, wait a minute, it didn't do it this time, so now what? Do we get out? Do we freak out? Do we sell our stocks? Is the market crashing? Is this the day? Is this the week? Well, all this is going on. I don't have any risk on this trade. I just want to see it hang out around 435. Okay, so are you following me on why I did that? Low risk, $5 commission, contract, high reward if this plays out like I see it playing out, and 0 capital tied up. Okay, so I put another one on today. Where would you guys think the next one would be the best place to put on today? Because it's real deep in the money, and that makes it real cheap. I got those for $4.80 credit. So on this one I put on today, I'm going to give you a hint. It's deep in the money, and I bought it for $4.80. I did 3 contracts this time because on a $5 spread, I only have 20 cents at risk, or $20. So on 3 contracts, I risk 60 bucks. Okay? You follow me? 20 cents, $20 per contract, 3 contracts, 60 bucks plus commission. I risk 60 bucks. This one's deeper in the money. When it's deep in the money, no one else is playing there. I'm looking at it, speculating, saying, okay, here's what could potentially happen this time if the scenario I just created for you guys doesn't pan out for the number 6 time. It did it 5 times, but let's say it doesn't this time, and it decides, no, that was too easy for us to just bounce this thing again. Where do you think I put my next trade today?
The red line at 425.
Bingo. So I put one on a 420, 425, 425, 430. And it cost me I collected $4.80, so I have 20 cents at risk. So if what I'm liking to see happen, and even Mitch confirmed he agrees, I don't remember if it was Mitch or Razor, y'all sound a little bit like, one of y'all confirmed and said, yeah, I think that's what's going to happen too. If what we think is going to happen actually happens, where they don't make it quite that easy, and the market does start to fall out, a 100-day moving average is a really strong average, and they don't violate it real quickly. You know what I'm saying? And if they do, they bounce it back to it quite often, just because they're not willing to just tank through. It's got to be a big event. Something's really got to happen that's bad for that thing to go through a 50, go through 100, and just keep on falling. They don't just drop it through there. It may go to it or go through it a little bit, but they'll bring it back. Unless it's a big event, they'll bring it back, and that's what I'm playing for. Is it gets there, because they did the opposite of what they've done 5 times in a row, and people get caught off guard. So it goes down to the 100-day, gets there, and now everybody's thinking, okay, is it going to bounce off this 100-day? Is it going to foul it? What's going to happen here? So you got everybody thinking day after day after day, and as the days progress, it gets closer to my expiration. I'm getting paid for it. So now, you see why I trade these kind of trades? I'm not sitting here.
Oh, I love them already. I've only done one.
I'm not sitting here going, I'm short Macy's. I got on the front end. I'm down. Okay, I'm gonna add here. Like I was talking about Razor before you got here, Mitch. We're like add. We added on the front side. Now we're down. We got $10,000 invested in Macy's short, and we're on the front side, and the damn thing won't drop. And it finally gets to a top, and then it drops, and you don't take advantage of the backside of the move. And you watch it drop, and then I have to listen to everybody say, man, I wish I would have added. Man, I should have added. If I'd have added there, if, should have, could have. Don't care. You didn't. So while all you guys are stressing out over that, I got a dozen of these plays on I barely even look
at. That's why I kind of like the options, because like when I find or at least when I'm doing swings and stuff like that, I constantly want to check it and then get out when it's not going against me. But it's like you just have to let it work. But it's almost like the options when you're invested, you just pay whatever it is, and you're forced to let your ideas.
Yeah, there's no stress.
Yeah,
I don't even look at mine. I don't even care.
This trade that Razor is in, it's going to go against you the day you put it on, because you're filling at the mid, which means you're already at a little bit of a disadvantage, because obviously you'd want to rather be at the bid. It's not going to fill you at the bid. So you're down a few bucks on a contract when you fill. So it was down on Friday when we filled these. However, on Monday, the market shot up, and we were down a little bit more, but it was never that brutal. It was no more than about 13 bucks on a contract. And ever since Monday morning, this trade has been green and never looked back, has it, Razor? I mean, he could have closed it Tuesday. He could have closed it Wednesday. He could have closed it Thursday today. Today he could have closed it for. It's not a lot of profit if you decide to close it, but profit's profit. I personally would rather wait for him, but I think it made it to 50, 55 or 58. But keep in mind, he paid $5 at commission to get in, 5 to get out. So at 10, that'd be $48 profit, which isn't a lot. But $48 against $10 worth of commission, against no capital tied up, and against a $98 loss is a 50% gain. So he made a 50% profit on a trade. So the simple solution to that is you just size up bigger. You still use no capital. But if I do these classes, and I know we only said it at an hour, so we're gonna wrap this one up shortly here. If I go through all these different type of trades with you guys, you're gonna find something you like, and you're gonna say, I'm done with this short and these runners that are kicking my butt every day. I'm done with this. I'm done with that. I like this style of trade, whether it's the iron condor, or the straddle, or whatever, the iron butterfly, which is this one. I like this one. And you're gonna say. Or you may say, hey, I like that butterfly trade. It's a low, debit cost to get in it. It's a nice reward. So I'm going to find stocks that have decent implied volatility in them, where they move a little bit, but they stick in a range. They don't bust out of that range, because that's where that butterfly is going to work. And there's guys that just do that. They find trades that are conducive to that style of option trade. That's all they do. And they're not getting up in the morning at 6 waiting in the market to open to see if they're going to lose money, and they're not waking up in the middle of the night and taking Xanax because the trade's stressing them out. None of that's going on. If you buy calls or buy puts, yeah, that's going on, because those are designed not to work. You want to trade options the way they work, which is this way. So once I
was telling the guys,
what did you say?
Now I was saying earlier, if this pins at the 440 and we make that $1,000, I was telling the guys earlier, you could put the 1,000 back in and do, what would it be, 20 more contracts? And if you manage to win that time, you'd be up $100,000 in 2 plays
You want to know how you'll never lose doing what we're doing here? Take
by buying tons of different
No.
ones.
take the profits that you make. Let's say, okay, most of these, if you listened, I was telling you on the one I just did today, I got a $20 contract risk. Okay, on the other one I sold at 68, so I got a $32 risk. On the one we sold at 451, you got a $49 risk. So those three combined, you got 49, 32, you're 81 plus 20, you got $100. Okay, so if you have three totally separate trades on it and your risk is $100, take the profits that you make and never risk more than you've made. At some point, you will get so far ahead on these things that you can then say, okay, I'm up $2,000. I never risk more than 100 or 200. I'm going to increase my size. I'm going to do 10 contracts rather than 2 or 3. That's when you want to do it, because you can actually set this up to where it in theory you can make 7 or 8 trades and win, and only have one that don't work. You see what I'm saying? You have one that don't work, cost you $98, but you have one that works and it makes you $450. You can have a whole lot of them that don't work at $98, especially if you get a couple that win.
Right.
You know, you can.
You only need to win 1 out of 7 or something. I think we did the math on it last time.
Yeah, I mean, you win one and it pins. You got 2 contracts, or let's take the one I put on for that 425 pin on the 100-day. Let's say that thing works. I got 3 contracts at 480. Let's say I get really lucky and it pins 425 right there, 425, 426. You know, I would collect $380 times 3, which is what, about $1,300. At $1,300 to get that one pin, I can have a whole lot of them at $20, $30, $60, $80, $90 not work before I get to $1,300. And the other thing I was telling Razor earlier today is I've spread myself across the board. I have a top side of $445 and a bottom side of $420. So, you know, I'm going to add some more. I want to get myself in a $50 range, because if I get in a $50 range, I got a pretty good chance something's going to pin in there. One thing to be careful.
So are you usually playing SPY or XSP or
Always
whatever it
XSP.
is when?
Always XSP.
Yeah.
Since it
So
came out.
that's usually your play for the
Yeah,
contours.
it trades exactly the same as SPY, dollar for dollar, but within a dollar.
But why not play like a less volatile name, I guess, like a ticker
Yeah.
that's.
You have to be careful, because when you sell a option, you've been paid a premium and you relinquish your rights to that stock or that option. You've given it to somebody else. Okay? So if I sell a 440 call for $40, somebody, market maker, whoever, has paid me $40 to now be able to make the decision on what they want to do with that 440 call. And they can assign that thing or exercise that thing, and it's out of my control. And so when you're doing these spreads, I've had it happen several times on me on SPY. I've had it happen on GLD. I've had it happen. GLD was because there wasn't enough volume, and what I was doing was selling what's called in the money vertical spreads, to where you sell one call and you buy one call, and you want the thing to trade under both of the strikes, because then there's nothing to close. Both of them become out of the money, and whatever credit you premium you collected, it becomes yours. And I tried it on some different stocks, and when I did it on GLD, a couple different ones, I was getting exercised on the stupid short legs. And I called my broker and I said, "This is crap. I put this on as a vertical spread where I bought one, sold one, and I've had GLD exercise me, 900 shares or 1,500 shares." I said, "This has happened to me like 3 weeks in a row." I said, and you know what they tried to tell me? They said it's random, it's computer generated. I said, "No, it isn't." I said, "I got assigned 3 weeks in a row." I said, "That's not random, and that's not computer generated." I said, "It's something else." So I got to looking at with him, and what it was is there was not a lot of liquidity in the options. The volume was low, and he tried to tell me it was a computer generated random assignment. I said, "No, that's not it. It wouldn't happen 3 times in a row, because my luck is not that good." or my unlucky is not that good. So when we got looking at it, he said, here's the problem. He said, when you're selling stuff that's in the money, there's not a lot of volume. There's not a lot of open interest. So you're a target when somebody else wants to make the opposite trade. So he said, they're assigning this stuff to you because you're getting paid premiums on the short side. He said, so that's what's happening here. So to answer your question, you just got to be a little careful when you're doing stuff outside of XSP that cash settles, because you can get assignments. And I've called my broker on some other ones that said, dude, you're giving them that right anytime you sell an option. You're giving them the right to exercise it or assign it or whatever, the opposite side of your trade, you've relinquished your right to that. So I'm real careful on what I play it on, because we're playing stuff that's in the money, especially the one we put on Friday. We were in the money on the bought and the sold calls. $7 in the money on the sold ones and $2 on the bought ones. So we're playing in the money. So when I sell that 440 strike on SPY, someone else has the ability, to assign those shares to me, or assign me short shares, which that's where you really get screwed. I got hacked on SPY. I'll be honest. What happened is I did it with SPY, and I did it through a dividend. And what happened is they exercised my short ones to me, which made it have short shares come my way. And it was an IRA. You can't take short shares in an IRA. So what happened is I ended up with just the long side of the trade. So I thought, not doing SPY anymore.
Okay, I got you now.
Yeah.
So I was also looking at playing options in an interesting way. And it would be like scalping them on one of my strategies for just like a stock would be like just an opening range break on like a gap and go or something.
Okay.
Let me see if I want to see if I kept the.
Do you guys want me to
Hold on one sec.
are we done talking about what I wanted to record for the class?
Yeah, I
Want me to
think
kill
yeah, I
that?
guess the class is good. Yeah.
Stop recording. Okay, yeah, because I'll stop that.